India's financial system has witnessed repeated jolts in the form of scams. From Harshad Mehta's stock market manipulation in the 1990s to Ketan Parekh's securities fraud in the early 2000s, and then the series of banking frauds that unfolded in the 2010s, the story has been one of systemic weaknesses, poor oversight, and opportunistic exploitation. By 2017, public sector banks in India were already under stress, dealing with rising non-performing assets, NPAs, and declining profitability. The government was working on recapitalization measures to save them from sinking further. And just when stakeholders thought the sector couldn't face another blow, news broke of a massive scam at UCO Bank, a state-owned lender headquartered in Kolkata. The scam, worth Rs 700 crore, revolved around fake letters of credit, LOCs, and mismanagement of funds. While the Punjab National Bank, PNB scam involving Nirav Modi and Mehul Choksi grabbed international headlines in 2018, the UCO Bank case, which happened around the same time, was no less significant in exposing the deep cracks within India's banking system. This essay takes you through the complete story of the UCO Bank scam, its modus operandi, the aftermath, and most importantly, the lessons it holds for investors, policymakers, and ordinary citizens. To understand the weight of this scam, we first need to know about the bank itself. UCO Bank, originally established in 1943 as the United Commercial Bank, was born out of India's colonial financial landscape. Its founders envisioned it as a bank that could serve India's growing trade and industrial requirements. In 1969, UCO Bank was among the 14 banks that were nationalized by the Indian government, cementing its role as a public sector bank, PSB. By the 2000s, UCO Bank had built a pan-India presence with branches in rural and urban India, and also had an international footprint with offices in Hong Kong and Singapore. However, like many other PSBs, it was weighed down by bureaucratic inefficiency, a slow decision-making culture, and increasing bad loans. By 2017, UCO Bank was already classified by the RBI as a weak bank due to its high NPAs and low profitability. Investors were cautious, and the government was under pressure to fix its structural inefficiencies. It was in this environment that the Rs 700 crore scam unfolded, making matters even worse for an already struggling institution. The year was 2017. At its branch in Mumbai, UCO Bank found itself entangled in one of the most shocking financial frauds in its history. The core of the scam was the issuance of fake letters of credit, LOCs. But what exactly are LOCs? A letter of credit is essentially a guarantee issued by a bank to another bank or institution, assuring that a customer's payment will be honored if they are unable to pay. It is a common instrument in international trade and large domestic transactions used to build trust between parties. In the UCO Bank case, senior officials colluded with businessmen to fraudulently issue LOCs without the necessary collateral or proper due diligence. These fake LOCs were then used by companies to obtain funds from other banks, creating a chain of financial exposure. In short, UCO Bank was vouching for payments that were never backed by actual assets or creditworthiness. This fraudulent mechanism allowed companies to siphon off Rs 700 crore, while UCO Bank was left holding the bag when the payments inevitably defaulted. The scam followed a clear pattern, similar in structure to the PNB Nirav Modi case, though on a smaller scale. Collusion with bank officials. Insiders at UCO Bank were crucial. Without their active participation, the scam couldn't have worked. Officials misused the bank's SWIFT system, Society for Worldwide Interbank Financial Telecommunication, which enables banks to send secure messages about international transactions. Issuance of fake LOCs. Fake LOCs were created, showing that UCO Bank had guaranteed loans or trade transactions. Other banks, relying on this assurance, extended credit to the companies involved. Siphoning of funds. The companies received funds and used them for unrelated purposes, not for the transactions they claimed. Much of the money was diverted, laundered, or used to repay other debts. The domino effect. When the time came to honor the LOCs, the fraud was exposed. UCO Bank had no backing assets, no collateral, and no way to fulfill the guarantee. Losses piled up, amounting to Rs 700 crore. The scam was not just a case of fraudulent paperwork, it was a systemic failure of checks and balances. Investigations revealed that a network of businessmen and UCO Bank employees were involved. Businessmen beneficiaries. They orchestrated the scam, convincing or bribing bank officials to issue fake LOCs. Many were small-time traders trying to scale up their businesses without adequate capital. Bank officials. At least 2 senior officials of UCO Bank were accused of misusing the bank systems to issue LOCs without following due process. Middlemen. In Indian banking scams, middlemen often play the role of connectors between corrupt businessmen and pliable bank staff. The CBI later arrested several people in connection with the fraud, though as with many financial crimes in India, the judicial process has been slow. The UCO Bank scam was not just about a few corrupt individuals. It reflected deep structural flaws, weak internal controls. UCO Bank's internal audit systems failed to flag the issuance of fake LOCs. The use of SWIFT was not properly integrated with the bank's core banking system, CBS, regulatory blind spots. The RBI and other regulators had repeatedly flagged the issue of PSBs being vulnerable due to weak governance. Yet corrective action was slow and often reactive. Culture of complacency. Many PSBs operated under the assumption that they were too big to fail because the government would always bail them out. This created a moral hazard, where accountability was often missing. Link to PNB scam. Interestingly, the UCO Bank scam unfolded around the same time as the infamous Nirav Modi PNB scam. Both scams exploited the same loophole, misuse of LOCs and SWIFT systems. The fallout was devastating. Financial losses. The bank reported a direct hit of Rs 700 crore. Reputation damage, already considered weak, UCO Bank's credibility eroded further. Stock market reaction. Shares of UCO Bank plummeted as investors lost confidence. Government pressure. The scam forced the Finance Ministry and RBI to rethink governance at PSBs. By the end of 2017, UCO Bank's financial position worsened. It slipped deeper into losses and had to rely heavily on government recapitalization to survive. The UCO Bank scam, along with the PNB scam, highlighted how deep the rot was in India's public sector banking system. Loss of investor confidence. Investors became wary of PSBs, shifting preference to private sector banks like HDFC, ICICI, and Axis. Spike in NPAs. Fraudulent loans added to the already ballooning NPAs in the system. Reform push. The government accelerated banking reforms, pushing for consolidation of PSBs. RBI tightened guidelines for LOCs and SWIFT integration. International scrutiny. With foreign investors eyeing India's banking sector, scams like these raised red flags about transparency and governance. The Central Bureau of Investigation, CBI, took charge of probing the UCO Bank scam. Several arrests were made, including bank officials and businessmen. The Enforcement Directorate, ED, tracked the money trail, looking into laundering and diversion of funds abroad. However, like many financial scams in India, the judicial process dragged on, with limited recovery of funds. For UCO Bank, the bigger challenge was survival. It had to be placed under the Prompt Corrective Action (PCA) framework by the RBI, restricting its lending and expansion activities until its financial health improved. The UCO Bank scam offers several critical lessons. Technology integration. Banks must fully integrate systems like SWIFT with their core operations to prevent manipulation. Stronger audits. Internal audits must be real-time and independent. Delayed checks are useless in preventing fraud. Governance reforms in PSBs, political interference and bureaucratic inefficiency must be reduced. Accountability of top management must be enforced. Investor caution. Retail and institutional investors must be careful while investing in PSBs. Understanding a bank's NPA levels and governance track record is crucial. Judicial speed. Faster resolution of financial crimes is essential to recover funds and deter future scams. The UCO Bank scam of 2017 may not have grabbed as many headlines as the PNB Nirav Modi scandal, but it was symptomatic of the same disease, systemic weakness in Indian public sector banking. For UCO Bank, the Rs 700 crore fraud was another nail in the coffin of its already weak financial position. For India, it was a reminder that reforms in banking were not optional, but urgent. Today, as we look back, the scam stands as a case study in what happens when governance fails, technology is misused, and accountability is absent. For investors, the message is clear. Trust in financial institutions must always be backed by due diligence, not blind faith. And for policymakers, the scam reinforces a lesson India has learned many times but often forgotten. A banking system is only as strong as its weakest bank.